So welcome to this Lothians Women in Agriculture meeting on benchmarking. Glad you could all make it. For those of you who haven't yet met me, I'm Tiffany McTaggart and I will be running this Lothians Women in Agriculture group this year whilst Mary Jane is on maternity leave. So this is the first meeting this year and we've got two more planned, with one in June, which is part of the Motivate and Inspire series, where we're hoping to have an inspirational speaker. And then the final meeting to take place will be in September, and I am open to suggestions on the topic. So if there's any requests, please let me know. I've got Craig Bothwell here tonight helping out, making sure everything runs smoothly. And we are joined by Bevan, who has a wealth of experience on benchmarking, and it's no better person than him to talk us through it. So over to Kev.
Right. Okay. Well, thanks for the welcome. And well, I was going to say glad to be there, but I'm not there. But yeah, strange times. But I think one thing we have learned in the last 12 months is how good the technology is these days. I think quite amazing that we can be doing this, hopefully and everybody with decent signals. So anyway. Now, hopefully the first hurdle now is to share the screen. So, oh yeah, Craig's got the thumbs up, so everything's good. Right, so let's see if this works. Share screen, there we go. Share. Right, okay. Are we? Now, how's that looking, everybody?
That looks good.
Is it? Right, okay, lovely picture. Don't know where it is, but anybody know where that is? No, right, oh, well, anyway. Okay, so what I'm just going to do is, this is just a little 5-10 minute preamble just to set the scene, because effectively that's what we're wanting to achieve tonight, really. In an hour and a half, we've got, once we've got a fair amount to cover, hopefully it shouldn't be too bamboozling. And the good thing is as well, hopefully it's a good thing, is I've added a couple of slides onto the Excel file, and that will be available for everybody. So if you do miss some of the figures that I pop onto, then you'll have this file to look back on it. Okay, so we just want to understand how benchmarking your accounts can help your business. So a bit of a chat there. What benchmarks to use and where to find them. An important thing tonight is to perhaps help you navigate around the FAS website, and because it's a little bit Sherlock Holmes required to find some of the stuff. How to also find where the FAS benchmarking tool is, and as you'll see in a minute, it's just a glorified calculator. The great thing about Excel is it is very, very easy, handy to use. And as you'll see, you can also add things to it quite easily. So, and very importantly, we want to certainly spend the last half hour talking about interpreting benchmarks, because remember, the big idea of benchmarking is to help you improve business performance. Okay, so on to the next one. There we go. Yep. So I think I just nicked this out of the Google Dictionary this afternoon. I think the point I'm trying to make here is we're not just talking about accounts benchmarking. Of course, that's what we're going to be talking about tonight. But when we think of benchmarking, it'll be, you have your silage analysis done. So effectively, we're benchmarking with that. When you get your soils analyzed, we're essentially benchmarking there. So it's not just accounts. Oh, environmental, very important now, of course, and water quality, soil carbon. That's something I suspect we'll be doing a lot more benchmarking of in the coming years. But the area we want to focus on tonight is on the financials, and in particular, how to get hold of your tax accounts and to get some worth out of them, other than simply to meet, to send off to the HMRC. There's also livestock enterprise. So for instance, if you are using Farm Bench or QMS benchmarks, then you can have crop and livestock enterprises as well. We're not going to get down into that depth tonight. We're going to stay at the whole farm accounts level. Right. Now, the great thing about your accounts is that most people consider that, well, they're just a necessity. We've got to do them for tax reasons. But there's a wealth of information in them, because effectively what is in those accounts is what you've done in the last 12 months in terms of what you've sold and what you've bought and spent and invested. So effectively, what we want to do is to turn that cost into something of value for helping you, make better decisions going forward. Of course, there's the three elements in accounts. They look at cash, they look at profit, and they look at capital. Well, they don't look at cash that much, but they certainly, you'll have your profit and loss sheet, and you'll have your balance sheet, the capital element. Now, I understand that the balance sheet has already been covered, so I'm not going to look at that tonight, because there's plenty to do with the profit and loss account. Now, just to get these kind of warnings out there, important, we look for trends. Don't fixate on a single year. It might have been a very good year in general, but unfortunately you got hit by the bad weather in your part of the world, and it hit your crops for 6, or you had an outbreak of pneumonia in your cattle and it was just your unlucky year for that. So always remember, we're looking for changes over time. Important to remember as well that accounts are often historical and can be very historical. You could be looking at the situation 2 years ago, and a whole heap of things have changed in that time. So we need to take that into account. As I said, accounts are prepared for tax reasons, and for those of you that are in that have got limited companies, they tend to make them as opaque as possible. So actually extracting information, certainly out of limited company accounts, can be quite a problem. Okay. But remember, there's other things about, even if it's a partnership or a sole trader, that how things are valued. Again, we're not going to look at balance sheet tonight so much. There's someone, I'm getting a bit of feedback, or I'm hearing someone, and not probably be best if folk are on mute unless you're going to say something. Sorry, that'll be grand. Right. Yeah, so remember, even with a partnership or sole trader, that your accounts will be, if your accountant's any good, he's trying to, or she is trying to reduce your tax bill legally. But so there will be some things in there that you will know that for, it's been a good year, so you've ended up buying, doing, repairing the farm road and, and doing a lot of drainage, basically to keep the tax bill down. So remember to take that into account as well. Watch for per figures as well. As you see, when we get to the interpretation bit, we can bamboozle ourselves by looking at on a per hectare basis, a per cow basis, per grazing livestock unit. We can confuse the hell out of ourselves on that. So per figures are perfectly good, but used, wisely. And the last point here is that all farms are unique. Now, we are benchmarking very often against other farms, but every farm is unique. It's not like a widget factory as such. Your soils are different, weather different, etc. So there's a uniqueness about your own farm. So that's where often comparing to how you did last year, and also how you did compared to how you budgeted, the year ahead. That can, to my mind, is one of the best benchmarks. You've set your targets for the year. What did you actually achieve? Okay, right. Now, that slide there is just to show that in the fas.scot website, that's where we can find a bit on benchmarking. So again, these slides will be available after. So if you need that for reference, you'll be able to find it. Now, I think that's this part over with. So now I won't ask for any questions at the moment because I will dive into the main thing. So if I stop sharing this, and then hopefully we'll share screen and we'll bring the next bit up, hopefully. Right, okay. Oh, right, this looks hopeful. Okay, everybody see that?
Yes, I can.
Good, superb. Right, okay. Now what I've done is this is the file that got sent out by Tiffany, and essentially all I have done is gone and scrubbed out a few columns here, and we'll build those figures back in so that we can kind of have a leisurely navigation through this sheet and some of the other tabs. Now, as you'll see, I've actually added a few more tabs to the ones that to the file that got sent out. And as I said earlier, this will be available if you want it. So this is a very simple Excel spreadsheet. Hopefully you should only be able to type in the gray bits. If you click on anywhere else, it should kind of say, no, you can't do that. Okay. So stick your name in. Now, farm type, just to get that one out of the way, if you're a dairy farmer, because the benchmarks we're comparing against are prepared by the Farm Business Survey team at SAC Consulting. And they go around, well, it's about 400 farms now of various farm types, so that effectively they can build an average figure up for that farm type and how the best quarter are doing as well. So they provide, the benchmarks. Now, depending on what livestock and crops you've got, will determine what farm type you are. And we'll have a little look when we have a look where the benchmarks are, and you can see the different farm types. We can come back to that if you want a bit more explanation, but this farm, which is a hypothetical farm, is specialist beef, which essentially says that they grow some crops. So what I'm going to do is I'm just going to pop together some of these figures, but it's a 409 hectare farm. Now that's the adjusted area. Now, dairy farms, lowland farms, the total area is about the same as the adjusted area. But if you go up the hill a bit, you've got rough grazing. What we tend to do is convert that rough grazing into the kind of equivalent of your improved land. This farm, nice and simple, it's about 409 hectares. And they actually grow 30 hectares of crops as well on the place. So that gives you your forage area. It's not a dairy farm, so we don't fill that one in. I'm not going to talk about grazing livestock units, but I'll just put them in there just for completeness. Oh, just going back a moment. What I'm basically doing is completing column D. So we're going to go down this column and complete it first. You can see that the previous 2 years have already been put in. As I said, you're looking to see what is happening over a number of years if you've got the information available. Now, what you can see and what can be quite off-putting to people getting an understanding of accounts is the jargon which is involved. Like, look at it already, you know, enterprise outputs, variable costs, total gross margin. Now, what the heck is that all about? Now, there's a little tab and it's got definitions on it. So if you're ever a bit confused, you just go on there and hopefully it'll tell you what makes up, for instance, enterprise outputs. So sales adjusted for valuation changes, less livestock purchases. What's in other trading income? Well, it's way leaves, LFAS, and things like, you know, farm diversification, you know, shed rentals or something like that. Okay, so if we ever get a bit lost, and because you'll be faced with your tax accounts and things won't be ordered necessarily. In fact, they definitely won't be ordered as I've got them here. And what you can see is we've summarized them right down. Okay, as you'll see, variable costs, we're going to shunt them all together because for the level of benchmarking we want in here, we don't want to bamboozle ourselves with too many figures. Okay, we can always go in and look in greater depth later, you know, if you want to look specifically at how your spring barley is done, etc. But at this point in time, let's start off with the big figures and drill down.
Yeah, see when you're talking earlier about your rough grazing correction area, what would the standard rough grazing correction be compared to well, region 1 ground?
Yeah. Well, with regards to rough grazing, it's all worked out on how much feed, how much pasture it grows, and very typically we would say something like 3 to 1. Now, if you go up into the northwest where you've got a heap of scree and gorse, it might be, you know, 10 to 1. But so, you know, if you are really, really extensive, it might be 10, 20 hectares. Now, don't get too hung up on it because you can well imagine that starts to get very subjective. And I suppose the interest in development now is where we probably want to be making out how extensive we are, is I suspect we'll probably be talking more about, well, my real stock in rate is 0.3 livestock units per hectare. But it's a very rough equivalent like that. I generally put about 3 hectares on a, you know, your sort of country in the east. Okay. Does that answer that?
Yeah, no, happy. Cheers.
Okay. Now, enterprise outputs. So what I would just want to do is I'm not going to go through all these painlessly one by one if you're thinking, and we're going to be here till 11 o'clock. But what I've done here, back in figures, you go. So what I just thought is I'm going to get these, this is the output. So if you can imagine this, it might be how it's presented on a set of accounts. But what I'm going to do then is go in it. Now, the great thing about Excel is you don't need to sit with your calculator, punch it into a calculator, then punch a figure there. Because, of course, the beauty is you can just pop all this stuff in, you know, together. So what we want to do is put the cattle sales in. We want to put the crop sales in. We want to deduct what, you know, they bought a nice bull. So 10,000 comes out there. There you go. And we've got to adjust for valuation. So you always add in the closing valuation and take away the opening valuation. So hopefully, if we've done this right, we should come up to 225,000. Oh, happy days. There we go. So you can see there that, and whenever, and you know, 20 minutes later, you'll be going back or you find that your figures are not adding up. The beauty of this way, the beauty of this way is you can go in and you can see exactly what you've put into that cell. So it's quite handy doing it that way. Trading income, effectively, we've got a bit of shed rental. So we've got 10,000 shed rental, you know, nice round figures this farmer's got. And they've got 1,250 quid of way leaves. So that goes in there. They haven't got any LFAS on this place. So that pops in there. And for BPS and couple payments, now the way the survey does it is they don't put the couple payments in with the cattle enterprise output. So what we've got there then is we've got 60,000 BPS and 24,000 calf scheme, and hey presto, this has all been adding up, and we should end up with 320,250 pounds of output. So you can see, and the good thing is your set of accounts, remember, you'll be familiar with your own accounts. So with not too much effort, you should be able to go through, pull those figures out. And of course, the beauty is you can compare them to what's in the accounts, because at the end of the day, your bottom figure for profit has got to come out exactly the same in what you put in here as what you're looking at in your accounts. The variable costs, as you can see here, let's just have a little look-see again what we mean by variable costs. Okay, so these are the costs of inputs. Now they're adjusted for stocks. So remember, this is where, where your silage stocks and all are there. And these are ones which basically adjust with the level of output of the enterprise. So the main ones we're interested in here is like purchase feed, straw purchase, keep, vet and med, and the forage costs and the crop growing costs as well, fertilizer sprays, sundries, livestock sundries. So it's all of those. Now, some of you will be saying, hang on, what about casual labor? Now, in actual fact, with labor, what we do, the convention is, if you look at a lot of textbooks, they would put casual labor in against an enterprise. But what we do here is we put all the labor, whether it's casual or regular, hired, in as a fixed cost. Likewise, with power and machinery, we put all the contracting in here. There's a very simple reason for that, especially nowadays, is that you would have a real problem comparing a farmer that does a lot of their own machinery operations and sells with their own labor compared to someone who uses a lot of contractors. So this effectively treats, puts it as good as possible on the same basis. Okay, so you can see there again, if you get a bit lost, pop onto the definitions and you can see where the variable costs, what makes them up. So what we've got here then is going back to this, and I can just pop that in very quickly. There we go. 871. And there we go. So we've got our gross margin now, which has come up. And in terms of labor, I'll just quickly punch these in because we're not going to stand on ceremony here, because hopefully you can clearly see now that where you would be, looking to find this info. And by the way, in most sets of accounts, the fixed costs are much better split up than the variable costs. It seems to be practice wherever you are in the UK is that they like amalgamating variable costs. So there'll be livestock, feeds, manures, and everything bunged in together. So it can be very difficult, as I say, to try and pull those apart. And those of you that have tried to do enterprise costings will have probably felt, that your world ending as you try to unpick them and go back to the invoices to try and work out what the hell went into that very big figure. Okay, as I said, what we're wanting to do is get a relatively quick hit here. We don't want to agonize over it. So all the variable costs in there are going to give us a wealth of information without drilling down into the detail. Now, power and machinery, we've got 48,000 of that. We've got overheads, so that's all our kind of property repairs, general insurance, all that sort of stuff. 39,000 for that. Now, depreciation. Now, historically, people used to pop like machinery depreciation in with power and machinery, and property depreciation, if there is any. Lot of sets of accounts. You know, property depreciation is minimal, even though there are buildings wearing out. But what we do here is the depreciation goes in one row, and you'll see in a minute why it's very handy to kind of isolate that and show it separately, especially if you are in the cropping side of the country and you've got a fair amount of machinery, because depreciation is a big figure. Remember, depreciation is effectively shows you how much your asset is wearing out by, your machinery is wearing out by. So, you know, a kind of annual, you know, figure. So depreciation, 20,000, and rent and interest. Now, you can see all the rent and interest goes in there, but of which we pull out the interest element. Again, a set of accounts will show this nice and separately, like bank charges are all, will be in a separate, I've got to be pulled out so that the interest is shown separately. Now, you might have overdraft interest, you might have loan interest shown separately, and you might have HP interest shown separately. So it's pretty easy to find that info very quickly. What we end up with then, if we've done everything right, is we've got 142,500 of fixed costs, and we've got a net profit of just under the £50,000 mark. As we can see, a little bit down on the well, quite a bit down on the previous year. Now, what we're going to do here is carry on down this column, because we can get some really quite quick hits by just adding a little bit more information that when we come to do the interpretation, provides us with some really valuable insights into the business. Now, cash needs is, I'll ask, are people familiar with the term cash needs? I'd be surprised if many people were. Now, the cash needs effectively, it's very handy often to turn things around and say, what level of profit, what level of profit do we need to achieve to cover the cash needs of the business? Now, by cash needs, and again, let's just see, hang on, I don't think we've got it in definitions. Oh God, look at that, there we go, fantastic. Cash needs are the personal and capital expenditure, including loan and HP repayments. So effectively, this is what your drawings, you know, for tax and for living expenses, but also for reinvestment in the business. And the thing about what we're wanting to do is not as much look at what they actually were in that year, but what they are on average, or what they should be in the kind of, you know, on a kind of rolling 3, 4, 5 year basis. So for instance, you know, very importantly is how many families are living off this business, and what should they be paying themselves? Now, they might be only drawing 10,000 quid out of the business for drawings, but effectively what we wanted to put here is what should we be targeting as a, you know, sensible, you know, wage for ourselves. Now, what I've got here, and again, I think in my backing figures, yeah, so I've popped them here. So with this family, there's two families on this farm. There's mum and dad, and there's son and daughter-in-law. So I've popped the figure in here as £25,000, you know, per family. Okay, now you might say, well, hang on, you know, that's way too low. Yeah, you can put 40,000 in there, a family, if you wish. It's really, you know, as I said, this is a subjective thing, but it should be, you know, realistic. Okay, especially if you want the next generation to follow behind rather than go and get a job off farm. Okay. What we've also got in here is a figure to represent machinery reinvestment and property reinvestment. Now, very often what we'll find is that you've put a building up and the loan repayment is effectively gives you a very good idea with what kind of annualized reinvestment is going on the business. But they should, you know, and most modern farms where the steadings and the storage and waste, you know, slurry pits, etc., are sizable, then that property reinvestment figure is pretty big. You know, you go to a 200 cow dairy farm, and I tell you that gets to be a little bit of an eye-watering figure. Machinery reinvestment, likewise, that needs to be accurate. And the beauty is, depreciation gives you an approximation of what your reinvestment needs are. Not always, you know, like you know, if you're running your machinery down, and you can only do that so long before you've either got to reinvest or do something different. Okay, so you can see with the folks here that if I go back to this, and I'm just going to pop this in. Oh, there we go. So I'm just going to cheat here, and I'll just put the full booner in. There we go. So you can see there, 90,000 cash needs of this business. And, well, we'll come back to the interpretation in a minute, but you can see what that's done in terms of the net profit before depreciation. Right, good point. Why have I said net profit before depreciation? Now, what you will be seeing there, of course, is I've added back the depreciation of £20,000 there, or it's done automatically. And what I've then done is I've put my realistic figure for the cash needs of the business in there. So I've added it back in so I can then take it out again. And you can see, although it was 20,000 up here, I've put 22,000 for machinery depreciation. And hey presto, there's no kind of depreciation on buildings or up there at all. So there's obviously this extra chunk of property depreciation or reinvestment rather that's gone into this one. Cash needs is a very, very important figure, and that's why we often say it's better to start the conversation with that, to say, right, you know, what does this farm need to make? Now, coming down, oh god, there's a bit of technology, a bit of jargon for you, Ebitda, and there's a few variations of that. But again, to take the mystery out of it, that's all it is. Earnings before interest, depreciation, and amortization. Yeah, forget about that. Don't worry about that. But what all that's happened here is this little calculator adds those things back in. It takes the interest and adds it back in and the depreciation. So we come up with this figure. Now, these extra ones here we put in so that we can calculate this little benchmark called debt repayment cover. This one has become popular in more recent years with bankers, and it's a way of looking at how well the business can cover its kind of key needs. So what we're going to do here is we're going to pop in the drawings, but the interesting variation here is if someone in the farming families regularly works off farm, we put that figure in here as well. Now that is quite a departure in recent years because it was often, well, you know, what's that got to do with the farm? But for banks, they're having to make judgment calls, and they do now say if there's and it's very often, and I don't wish this to sound sexist, especially in with the Women in Agriculture webinar, but it's very often Mrs. Farmer that's working off farm. And what we want to put in there then is the kind of net salary figure, the kind of after tax, the take home pay. And what I've got here is to say £15,000 goes in there. Okay, so that banks very often like to see that now for this calculation. the next thing we need to add in then is how much our, not just servicing our debt, and by that I mean the interest, but actually how much capital you committed to paying back each year as well. And we're very familiar now with banks, and it's not just in Scotland, it's all over Britain and all over the world, but banks are now insisting on capital, repayment loans rather than interest-only lending these days. So that's why there's this interest in how much capital as well as interest. Now, this farm hasn't got much borrowings, so we've just got £27,000 worth of capital and interest in there. And this is on machinery. There's no loans, and there's just £100 worth of overdraft interest. So again, this is clearly showing that this farm basically operates in a positive bank balance for much of the year. So what you can see there then, we've added these figures in, and we've ended up with 27,100 there of total annual debt. We divide A by B, and we come to 1.3. And this is our little benchmark here, must be over 1.25 and must be over 1.45 if you're in pig farming, poultry farming. So that's the little benchmark there that's seen as an important one. Okay. Now we'll come back and discuss these in the interpretation in a minute. So total output, all these things are now calculated for us, because the one that you probably will be more familiar is rental equivalent, and this is rent and interest. You can see here divided into the output of the business. What we do add in is grass keep and winterings. This also comes into the calculation. So we put £10,000 there. So you go and find that if they're in your accounts, and you pop that figure in there. And the rental equivalent comes out here, it's 5%, which is way lower than the 20%. Now there's various gradations here. There'll be, comfortable, getting a bit scary, very scary type of gradation that, a bank manager will look at. What you'll obviously say, though, those of you that are tenant farms, is your rent alone might be, 15, 16, 18% of your output. So again, you can see from this farm, it's owner occupied, so less of an issue. The final little one then is where you also take drawings into account, and this gives a rental equivalent including drawings. So again, there's the kind of benchmark to compare against there. Okay, so that's the column there. Now, as I said, I'll pop on, because the interpretation bit I'll shut up, you'll be glad to know, and allow you to basically give you your thoughts on what these figures tell us. But that's column D completed. But what you will have now noticed is where we haven't compared them to benchmarks yet. So what we now want to do is we're going to go and find the figures to fill these two columns. What are these figures here? This is gross output analysis. Well, what the hell is that all about? We'll come to it and we'll explain that in a moment. But first of all, let's see if we can find where we find these figures now. Let me just see. So what I'm going to do, I'm just having a look. Oh, there we go. I'm just looking on Zoom there. Right. There we go. Right. So this is the Farm Advisory Service website. And where do we find these benchmarks? So here's rural business tools, and benchmarking. And what we want to find is these whole farm benchmarks. And hey presto, now the example there is from a few years ago, but if you're wondering if I've made those benchmarks up, well, I haven't, because very quickly, if we click on the 16-17 year, now back in the old days, we just used to put a publication together and put it up, and you could just print it off or look at it. So you could see here, remember I talked about farm types? Well, these, you'll think of your own farm type, and if you're over in the east, you've probably quite a few more of you will be specialist cereals. Some of you might be general cropping. Some of you will be mixed, which is tend to be mixed lowland here. Some of you are up in the uplands. You might be specialist beef and sheep, or you might be a more mixed cattle and sheep, more kind of equal sized. Okay, so we find the one we're interested in on page 12. I just quickly scroll. Oh, by the way, yeah, you can see all the bump and explains how you go about that. But hey, let's don't get bogged down. We go to page 12. Oh, there we go. So that's the figures here that we will be looking at. And I'm actually going to pull out the upper 25%. Now, this can be a little bit contentious, but really, if we're looking to improve, we target the upper quarter. Okay, so you'll see in a minute that that's the physical figures, and that's the overall amounts, and that is per adjusted hectare, and that is percentage. So hey, we'll see. Now that's from 3 years ago. Now look at this. We've got a bit of wizardry now. Last year, we decided to go all high tech. So what you can actually go in here now is you can say, right, well, let's say if you're a crop farmer, you might say, right, specialist cereals, let's go and look at that. Oh, wow, it brings those up. And you can go look at it per farm, percentage of output and all this. And what's really good is you'll see in a moment, we can actually download this. So I'm just going to go into specialist beef. I'm not slowing this down that much, by the way. I think very slowly, so hopefully that will help. Right, so download. So we've got our figures here, and the beauty is you don't have to download these individually. You just download for Excel, and what it does is that, hey presto, it'll bring these up in a minute. There you go. Now, the beauty of this, rather than kind of, print that piece of paper out and, get your calculator out and your pencil out, you can, of course, and I'm thick as mince on these things, so even I can do this, so you'll be able to manage it. You just click on that, of course, and we can move that cell. So create a copy of it. And if we've got this other one open, we can just go and move it to the end, and we can put it in there. So now, what we've also got now is we've got the benchmarking data there, nice and neat in this one file. So you've got it, so you don't need to go back onto the FAS website. You've got it there, and you can play around with it to your heart's content and do calculations on it. So now that was, obviously this is the wrong year there, but you can see my understanding is the figures, the benchmark figures for the 2019-20 year will be going up at the end of the month, the beginning of April. So the most recent figures, a lot of you will have your 19-20 accounts. So the benchmark figures will be available at the beginning of April if you're interested to have a look at them. So coming back to this, I'm just looking at the time here. We're doing all right. So what I'm just going to do, and in actual fact, I'm not going to waste time going through this row by row because I thought this afternoon, I thought we'd be getting a bit tired by this stage. So what I've actually done is hopefully if I flick to this one, hey presto, there it is. So by magic, I've got these figures. Now, yeah, now I've completely lost you because you're thinking, what the heck is 20? Well, there's the figure there, 34% what's this man on about? Now, gross output analysis is a very handy way. If you're Tesco's or Amazon, ratio analysis, as it's more often known in other industries, is a very good way. Like Tesco's, etc., always looking at what their gross margin percentage, etc., is. So it's a good way of comparing yourself quickly with another business, especially good in farming, because you don't have to worry about, how many hectares it is, etc. Because all we've effectively done here, if we see, is this figure of 34%. What we've actually done is we've taken the 48,379, that figure, and we've divided it by the output of the business, 320,000. So I'm completely taking out the wrong path. That 15% figure there is 49,000 divided by that. Now I think again, back in figures, yeah, there you go. There's my little calculation down the bottom. Oh, yeah, you can see. So profit divided by the output is 15%. So that's where that figure has come from. Okay, now likewise, the gross margin will be 191,000 divided by divided by the output. So it's a quick way of coming up with some very useful benchmarks. As I said, going back to this, these are the figures back in 2016-17 for the top quarter of farms costed in Scotland that were defined as specialist beef. So you can see here the figures. What we've also put in is the per adjusted hectare figures as well. Probably easier to understand because we've got this 409 hectares, this adjusted area for the McDonald's, but this is the average of the top quarter of the specialist beef farms in that year. And there's a little bit more of the physical information up there. I'm not, by the way, dwelling on some of these other figures because we'll get a bit waylaid if we on that, but we'll bring those into the discussions with the interpretation in a minute. Things like stocking rate, for instance. But so I'm only going to use these two because remember the rule about per figures, we can start to confuse ourselves. But if I was a dairy farmer, for instance, I would put how many liters of milk I produced, so I could come up with a benchmark on a per liter basis. If I was a beef sheep farmer, I would calculate how many kilograms of live weight I'm producing, and I would divide it in, and you can end up with a cost of production figure as a result. If you were a purely crop farm, you could well do that with your crop output to come up with a figure, but that's for another time. So what we've got then is very quickly we've whizzed through, taken figures from your accounts or the McDonald's accounts, populated them in here. We've also taken benchmarks from the FAS website and popped them in here. Now, what we wanted to do then now is get to the interpretation stage. Now, I'm just checking I think, yeah, we're on, my thing is saying 37 minutes. I think we said we'd be about 35 minutes. So we're okay at the moment, I think. There we go, yeah. So before we move on to the interpretation, should we have a couple of minutes? Just, are there any burning questions at this stage with actually how you put the figures in? There we go, Michelle.
Michelle, you're on mute.
Yeah, sorry, I'm off now. It wasn't so much putting figures in. I'm just slightly concerned, thinking just practically on our farm business. if we're benchmarking within ourselves, I can understand you can do that. But if you're trying to benchmark against other farms, I mean, we have four labour units, but only one paid labour unit. So how do you make comparisons like that?
That's a really good question, because that's where the cash needs comes in. There'll be a lot of talk about, and in dairying, for instance, some people actually put a value on home labour and they put it in. In actual fact, you can still go into the Farm Business Survey and they still produce something called management and investment income. So net farm income, for instance, puts the value of the manual work that the partners in the business put in. But we've simplified that a lot because that becomes incredibly complicated to kind of calculate. But because effectively what you're saying is, if you're comparing yourself to a farm that's you said there's 4 labour units, we're including 1 paid work member. Yeah, with your business. And so you're saying, how would you compare yourself if it was just farmer plus 3 workers?
Yes.
That's the thing. Yeah, now, interestingly, we'll often see that with when the younger generation is coming in and is on payroll. So the younger generation might be up in here. We might see it as well with company accounts, where there'll be directors' wage in here. What you have got to do is go off-piste a little bit with that and take that into account yourself, because as you suggest, this quarter here is going to be an amalgam of farms where they're all doing it themselves, so there's no labour bill, compared to ones where there's a lot of labour on there. Now, what happens, of course, is they tend to counterbalance each other. If in your case, your cash needs bill will be pretty high, but your labour will be quite low. So you're going to have to kind of interpret that yourself. But by the sound of it, you've identified that as an issue. So I suspect you'd be quite confident in, taking that into account. Okay. Again, that's where it comes back to the uniqueness of the individual farm, and comparing to yourself is generally the best benchmark. Okay. Any more questions? No? Right. Well, okay. Well, now what we want to do then is to get on to now interpreting this. So hopefully you've had a chance over the last few days to have a look at this. So what I've done here is I've just stuck some questions here to try and give a bit of structure to this last half hour. So if we just go in order then, and I'll just start off with the obvious then is we'll look for the obvious and we'll start with the big figures and then drill down into them. But if we start then on number 3, and as you can see here, I've got the ones where really we're comparing to self before we come on to looking at how we compare to other farm types. So what's the thoughts then, the trend with the McDonald's business?
Margot, do you have any thoughts?
I was just, my thoughts looking, the outputs are up and down. Enterprise, forget the subsidies, but I mean, they've gone from 228, they're now at, and then it went up to 240, and now 225. And I would be asking questions why that's happening.
Mm-hmm. Yeah, that's good. Anybody else?
Power and machinery costs have been starting to increase.
Yeah. No, interestingly, you've dived into the detail, which is normally what happens. Now, that's what I'm saying here. Start with the big figures. Now, I would dive in and look at this row first. Now, it's quite right, because yeah, you're actually on, you're onto it, like you're 3 steps ahead of me. But what
for analysing. Yeah, sorry.
But that's the row I would go for first. Now, it's a bit odd because I said start from the top down, but yeah, you have started from the top, whereas what I'm actually saying is we start from the big figure, which is at the bottom in this case. So what's happened in the last 3 years with this farm?
The profits variable, it's gone up in year 2, but it's back down again.
Yeah. We kind of thinking, well, those 2 years it was about the same, and it looks like the year previous was, a bit better.
Yeah.
And so we then drill down to try and explain that. Now, I think this picks up on what Margot was saying here, where she kind of lasered right in there, and because I always think, right, the next 2 layers down after profit, is profit better or in that year because fixed costs were lower and or the gross margin was higher? Those are the next 2 most important lines in there. So in terms of this, it probably looks, well, fixed costs were a bit lower that year, but it is more that the gross margin of the business was up. Remember, target jargon alert, gross margin is the output of the business, what you're selling, what where crops and livestock take away your direct variable costs. So that's it. So we're kind of saying, if the gross margin is up, why is it? And Margot was about 4 steps ahead of me on this. So what you quite rightly said was, well, yeah, that it looks like it was the output that was up in that year, because the variable costs, okay, they were a bit lower, but not that much. But it does look like it's output. Now, let's try and turn this into language that we understand. Remember, we said these figures represent what's happened on the farm. Now, this is a hypothetical example, but in your own instance, you'll be thinking, right, what happened, that year? Why was output up? Did we have a good year in terms of, in this case, we, cattle did well, in terms of calving percentage, the average carcass rate was up a bit? Or was it simply that the trade was good that year, or we bought, stores in well and we sold at a good margin? Like, that's the level of detail we've got to get back to, because ultimately we want to say, well, if we're looking to improve the business, are we identifying a problem we can sort out, or something we're good at? You might say, well, actually, we're quite good at the crops and not that good at the beef. Why don't we get less cattle in this year and grow more crops or sell more crops? Okay, so that's what we're hoping to pick up on. Okay, so that's the first thing we want to look at, is just to see how we've done over the last few years. Okay, so that kind of, and as I said, the reality is you will have a lot more backing information. You'll be discussing this at home. God, it was a good year last year. Well, it was great prices. Well, look at the sheep and dare I say the suckle calf trade in the last 12 months. Hopefully there'll be some decent accounts coming out this year on those types of farms. Now, moving on to the next one, interpretation. Now, this is one that I've always been keen on since we decoupled subsidies back in 2006, 2007. Because remember, the big idea at the time was to decouple subsidies so that we could actually see what we were making from farming. So profit before subsidy, if we go back to the figures. Oh, wrong one. Now, what's the thoughts on profit before subsidy with this business?
Making a loss.
Yeah, what sort of size?
Quite substantial.
Yeah, yeah. It's and because what we've said here, and remember that's why we've categorized the BPS and couple payments together. Incidentally, LFAS is up in the other row because it was a Pillar 2 payment. You know, it's a bit of a debatable subject whether we should be putting it all in here together. But you can see there's £84,000 worth of BPS and couple payments for this farm. So you take that away from 50,000, then there's quite a significant shortfall. It's not in here. You know, that's a separate calculation, but it's a pretty easy one to do. And certainly for those of us in the west of the country where we're dealing more with livestock, you know, used to kind of look and when talking to farmers and say, well, are we making a pound of profit without support? You know, as a good, you know, as a useful metric. Now, for some businesses, if you looked at dairying, for instance, you know, where support is relatively small in the grand scheme of things, then you would normally be seeing quite a sizable surplus, even if you took the subsidy away. But for some farm types, it is significant. And again, somewhat of a concern, given that we are perhaps expecting support to change perhaps quite markedly in the next 4 or 5 years, you know, even in Scotland.
Margot, do you have a question?
Yes, if you don't mind, I was just going to ask you about the percentage. Looking at that, their subsidy is about, what, 40% of their output?
Well, that's a good question. Where did you get
And I was just going to ask, sorry, I was just going to ask as a benchmark. When I saw that, off the top of my head, I'd have thought a benchmark was about 10 to 20%. Well, do you do such a thing? No.
Oh yeah, well, that's good that you've picked up on that. Now, actual fact, there it's 26%.
Oh.
Okay, yeah, you must have looked down at the variable costs, I think.
Sorry,
That's
sorry.
Okay. But that's a really good point to pick up on, and that's exactly why we have got that pulled out, because you can see there that and now for this type of farm, well, you know, it's pretty typical. If you go into a dairy farm, you know, it might be down under 10%. So
right.
Can I come in there and just ask, is that really 26%? If you add up the 84 and the 11, that's 95. I think Margot's 40% is probably more accurate.
All right. So, and the 11.
Other income's not LFAS, though, it's not subsidy.
Well, it is a form of subsidy.
Yeah,
they said they didn't get LFAS, so they said it wasn't an LFAS farm. Must be another income.
Aye, in this one,
okay,
yeah,
so
it's other income.
Shed rent.
Apologies. But it's still higher than 26%, surely.
84 divided by, well, 320, 84 is 26%.
Yeah, sorry, yeah.
Yeah, you know, but no, that's, I completely agree with you that really LFAS, yeah, you know, we've kind of, and it is significant on some hill farms, and obviously they're quite concerned about the potentially what's happening to it. But yes, this is flagged up as a concern because depends what's happening to support going forward. But yeah, if you have a look through the FAS.Scot for the various farm types, you'll again see it there, because remember, all we've done is done exactly the same in the Scottish Farm Business Survey. They will have done exactly the same and categorized it like that, and 22% in that year, the top quarter will get in BPS and couple. Okay, so interpretation. So yeah, profit before subsidy. Yeah, there's a bit of a concern there. with regards to that, with what's happening. Okay. So I'm just looking at my little crib sheet here, actually, and what I'd meant to say upon this bit, just to start with the big figures and drill down. Root cause analysis is a term that you'll undoubtedly be familiar with, and that's really the little technique that we use to try and find out exactly why your figures turned out for that particular year. The Japanese, I think, call it the 5 whys. If you ask 5 questions, why, you normally get to the root of the issue. So there we go. Now, coming back on track then, are cash needs covered? So remember, there's our cash needs. So what's the thoughts there?
Not without the off-farm income.
Good point. Yeah. And we can see there that, yeah, the farm itself, without the off-farm income, is not covering the cash needs of the business. So that would have, a warning. And by the looks of it, it did the previous year, but not the year before that. So it looks like more typically we're not covering the cash needs of the business. Now, what typically happens, of course, is families don't draw that much off the business to make ends meet. Now, you can hold your breath for so long, but it's not a position we want to be on an ongoing basis. And as we see very often, of course, is someone is generally working off farm to supplement the household income too. So cash needs, that would be a little bit of a warning one there if we were, that was kind of that we haven't been doing that in 2 of the last 3 years. What about debt repayment cover? So this is this relatively novel one here. So there we go. What's the thoughts there?
It looks as if they can pay their debts at the moment, but there's no money for investment.
Good, yeah, good, and that is a good point. As someone said, like what's squaring the circle is the regular off-farm income, but we, there's not much, there's not much new buildings going up. All right, things might be hunky-dory anyway, but the investment, that's a good thing to have put in there, because again, things last only so long before they need significant, a silage clamp. I don't know what's very often a 15 to 25,000 price tag, etc. These big lumps of money have to be found. But we've got our head above water in that respect. We're better than the 1.25, but you'll see quite a few businesses where that could be 3 or 4 times, if it's a combination of good profits and that they're well invested up, so it's things. But again, we're not necessarily saying you're a bad business if it's got a high, if the debt repayment cover is hovering down at 1.25. You might be a young business, growing. Now, again, banks are happy to support such businesses if they can see, they're growing, they're in that phase, and they can do it. They're top performers, they control their costs, so I should have made that point, and it's an important point with benchmarks, is be careful not to have favorite ones, that everything is all about that one benchmark. You tend to, like a dashboard on a car, you want to be looking at a range of them, and obviously some are more important than others, but some people do get beholden to some quite arcane kind of measures, and you think, well, hang on, Don't know if that has a great deal to do with your profitability, but hey ho. Going back to interpretation, where debt repayment. Now, rental equivalent is a bit of a variation on that. So what are the thoughts on the rental equivalent, which is just down here a bit? Oh, sorry, I should have said on that last one, of course, there isn't much borrowings on this place. So that you definitely be saying that's a positive. It's more about the low profit, which is an issue. Rental equivalent, here we go. So we'll just go down there. So the thoughts on that?
What was that again?
Yep. So the rental
Very
equivalent,
low.
yep, there you go, is so rent and interest from above, plus there was kind of seasonal grazings of 10,000. So is that £16,000 divided into the output of the business comes out at 5%. So, you know, it's like, you know, that would be seen as comfortable, but it's an owner occupied farm, you know, they are not paying off any big loans or etc. So that's comfortable. But again, if you were just fixated on rental equivalent, and I've heard some people that over the years have thought rental equivalent is a be all and end all, you'd say everything's fantastic with this business. Well, clearly it's not. The rental equivalent, including drawings, is not as good, but remember that's because the drawings figure that we have put in, you know, bumps things up, you know, puts a bit more pressure on the business. Okay, now those are the kind of we've gone down column D and we've kind of exhausted that, but you can see that you can actually do a heck of a lot of benchmarks before you've even got to look at comparing to other farms. Okay, but just for this last 10 minutes then, we can look at, well, what's the gross output analysis show us, and the per adjusted hectare as well, if we need to have a look at that. So coming back up then. So here we are. Those are the benchmarks from the top quarter of this farm type. And these are the gross output figures for the McDonald's for the last 3 years. So you can kind of see that profit, how that's varied and things. So what's the thoughts?
Put the for sale sign up.
Yeah, right.
It's not good, I would say. I still would like to know the output analysis.
Yeah.
But they've not got borrowings, which is positive. And their labouring is high.
Yeah. Again, you know, like that's it. That's it. So start off with this bottom line. And what we're doing effectively is compete. Now, one thing I should say is often if, you know, you might not have the same year to compare, don't get too hung up. In actual fact, we've probably rode back, and this was a particularly good year for specialist beef farms. I can't remember what was happening back in 2016, 17, but it was, because these are real figures in this column. These are just made up ones. So to keep a third of output as profit, you know, it was, you know, a pretty damn good year. We actually, for this type of farm in general, we would say you want to be above 20%. But, you know, by all means achieving 30%. But again, you've got to be a little bit careful because you can end up having a wonderful figure and giving the tax man quite a big check. So, you know, so there's obviously, you know, tax to take into account as well in your thinking. But interestingly, do you think you're picking up that these figures are very poor? Is that Anybody disagree with that?
Some of them are. It's a shame. It's not fair to. Their variable costs are huge.
Yes.
So
No.
why? You know, that I would be. I'd want to see what they're spending.
Yeah, that's good. Can anybody think of a reason why not just their variable costs, but their fixed costs look high? What might explain, like, by the way this is calculated, why their costs look high, whereas in reality they might not be that high? Because look over here, on a per hectare basis, their costs are lower.
No.
Are they quite extensive then, Kevin? Not having the output per hectare.
Yeah, that's it. That's what you have got to watch with gross output analysis, is that if you remember, we're dividing everything into output, this figure over here. So if you're a bit more extensive, then if you don't watch it, it makes you out to kind of, God, my variable costs are terribly high. Well, in actual fact, it's not. It's your output that's relatively low.
It's, well, yeah.
So that is one of the quirks of gross output analysis, just to bear in mind. But you're all saying exactly the right things. Is you're wanting to get behind those figures to understand what in reality is happening with those crops, those cattle, that real things. What have I got here? For instance, stocking rate, and we have got a little bit of stuff at the top here. You can see this is picking up on Craig's point. Yeah, it does look like they're a bit more extensive. Yeah, that's what now they're actually a lot smaller. That's the other thing you've picked up on, I think, Craig, is that this is quite a big specialist beef farm. That's the top quarter, only 147 hectares on average. So, you would expect their output to be dramatically more per hectare because they're more intensive. On it. But yeah, so the things you would be wanting to really get down into here is, well, if you're a crop farm, well, what's the average yield of your winter wheat, your oilseed rape? Is it a technical issue? No, you might say, well, yeah, hang on, I'm beating myself up here, but like this is not wonderful cropping land. I'm not down in the kind of God's country part of the East. So again, you've got to be careful not to beat yourself up too much, because you're making unrealistic, comparisons. But yeah, drilling down into that technical bit there, and if you're a livestock farmer, that's where the production calculator, how much you're producing of live weight. And the beauty, if you're a beef and sheep farmer, is don't try and split the cattle away from the sheep, because you will take a month of Sundays to do it, and you'll almost certainly come up with some arbitrary decisions that kind of make it, thing. In the first instance, a kilogram of cattle and a kilogram of sheep, it's still something you're selling. And so you just calculate the overall production of meat, and you divide, and you arrive. Now, the McDonald's was 104,000 kilograms of live weight they are producing. Now, there's no benchmark because we don't actually do much of that benchmarking in Scotland. We should, and hopefully there are more farmers. You'll see in the farming press every so often that someone has got a target, and they're looking over the next 3 years to increase it by 15% or what have you. So that's where the tie-up with the actual physically what you're doing on the farm is important. And as I say, with crops, it's not just about quantity; it's of course about quality as well. So with regards to the gross out analysis there, then we can say that, well, yeah, we're not doing as well as the top quarter, but we would have to delve in a bit more to see whether it was an output issue rather than simply a cost issue. Incidentally, you would have seen in the output figures, there's a lot more detail, for instance, on variable costs. So I've just merged them all together to come up with something quite quick. But quite a few of you might well be interested in saying, well, how does my vet and med costs compare to other, similar type farms? What about my fertilizer and lime? So there is quite a lot more detail when you actually go into the farm business survey figures. Okay.
Kev, the other thing I was just going to ask there is, if you are just a single enterprise farm, I mean, the farm business survey's got per 100 U equivalents, and they've got per head as well.
Yeah. You can definitely. I can think of like Orkney farms, for instance, which are all cattle. So you can actually sit down and you can get an absolutely kosher, calculation of what their cost of production, what their net margin is.
If you have a set of accounts for, say, for your beef, then that is what you would take your information off. Is that right?
When you say you've
if
got
you're running it as we run enterprises, the beef has its own accounts, the arable has its own accounts.
Right. Yeah.
Is that and there's a sort of split of overheads and things.
Yeah. Well, that's brilliant if you've got that, because effectively they always say this is like peeling an onion. So we've really only peeled the outer couple of layers, but hopefully you can see that we can get a heck of a lot of information about a business from just doing a whole farm. But if you've got that level of detail, you are then be able to say, well, is it the cattle or the sheep? Are they both pulling their weight, or is one not? Is one weaker? In which case you might decide, well, the cattle are doing better. I actually like the cattle more. Well, why don't we drop the sheep back a bit?
Don't get any sheep.
Oh, well, no sheep.
What an excellent idea, Kev.
Yeah, there you go.
But excuse me, can I just ask, does that not put your fixed costs onto the other enterprise?
Well, I suppose the interesting thing there is, as you say, if you're doing your little budget then to see, right, drop in the numbers, is very often, and I think I can see what you're getting at, is unless you, by changing the balance of the enterprise, well, there's two things there. If you substituted more, in my hypothetical example, more cattle in for sheep, and your margin was higher on the cattle, well, your fixed costs would hopefully be more than offset by the extra gross margin. I stuttered a little bit there because the problem with sucklers especially is their fixed costs tend to be quite high. It raises a good point, because when we're talking about enterprise performance, there's this debate over gross margins against net margins. Now, net margins take fixed costs into account as well. I'll be honest, net margins they're not the work of the devil, but they're not far off it. I'm always a bit confused why we put so much emphasis on net margins, because are the fences to keep the crops in or the sheep out? It gets very incredibly arbitrary trying to allocate fixed costs between enterprises. For the purposes here, I would say leave your fixed cost. Brian Pack, who many of you remember, he made the point that your enterprises are to contribute to covering your fixed costs. Now, when you actually sit down and say, right, I don't know if the cattle are doing well compared to the sheep, that's when you drill down into the detail of saying, if I cut the cattle back, what fixed costs will I be able to save by doing it? So it is important that we know which fixed costs are related to the cattle, the sheep, the crops. But when we come to actually budgeting to look at how we might change the business, because very often we see, of course, that you cut the cattle back, there's a hell of a lot less silage to make. You know, perhaps you haven't got to update buildings, silage clamps as much. So very often, especially, you know, if sheep have a, you know, another good year or so, you know, the balance, you know, then starts to shift, you know, in that. Cropping is very interesting in that, again, we can often get fixated on individual crops, but you crop farmers, I don't know much about crops, but I've always been told it's the crop rotation that's important. Oh, hang on, there you go. All right. Yeah, oh, you go. Technology is struggling, yeah, right. Yeah, with crops, it's the actual rotation that's important. So very often, to make a rotation work, you have to have an enterprise in there that, on standing by itself, it doesn't look that wonderful. But in the context of making a rotation work, it's essential. So no, the beauty is now we've kind of moved from benchmarking into looking forward, and that's exactly the point you want to get to. Simply doing accounts analysis and benchmarking is quickly gets boring. The real value is how now it sets you up then for really the important question of saying, right, how are we going to do things better, or in, you know, in the coming 12 months? You know, we're really good at that. Should we move more into it? We're not very good at that. Well, not a matter of simply getting out of doing it. How can we improve? You know, like what seems to be holding us back from, you know, getting better, you know, winter wheat margins or what have you. Okay, so now
that's great. Thank you, Kev.
Right, okay.
Is there any more questions that are burning? If not, you can easily send them to me and I can put them to Kev if there's anything else that you come up with afterwards. I think that was very informative, Kev. Thank you. I think that's very thoroughly taken us through benchmarking. I will be emailing out feedback forms. If you could please fill them in. If you fill it in, you get put into a prize draw to win our £50 voucher from either Battlefield Bakery or Damn Delicious, which I've heard are very good. So it is worth doing, and it'd be much appreciated if you could fill them in. And I will also send out the link to where to find the all the survey information, so you can get to the benchmarks easily, and Kev's updated Excel sheet, just so you can look back on it. So that's great. Thank you all for coming.